A lot of investors are missing something really important when it comes to the tariffs and market volatility, and it's a view you need to understand if you don't want to be blindsided by what comes next.
There is a bipartisan consensus in the US that whatever has happened over the last 30 years needs to change.
That's fund manager Ashish Bhardwaj, and he's been expecting something along the lines of Trump's announcements on tariffs for some time. And unlike many others, he didn't take a sigh of relief when the US and China announced their truce on tariffs.
We will see a long period of volatility because we are passing through a transition period.
This is a profound economic shift and one that many portfolios just aren't ready for. In this episode of Fidelity Answers, I'm joined by my colleague Charlie Wood, and we speak to Ashish and fellow fund manager Marcel Stotzel about what else investors might be missing. And I started by asking Ashish why he's digging in for another bout of volatility.
Yes, so we have to take a step back and see what has happened in the US over the last 30 years. And what we have seen over the last 30 years, US companies have tried to become more and more capital light and outsourcing manufacturing to cheaper locations like China, emerging market, to improve their margin and profitability. And it has had many impacts. The first impact which we saw on social impact. So the places which lost jobs, people who lost jobs, they did not get the equivalently good jobs. And first time we saw that in 2016 when Trump won election, largely because of those factors. So we had social political problems. And then during COVID, we saw a resiliency problem. When COVID happened, we realized that US was not able to manufacture enough masks, guns, testing kits, and so on. And then we have national security problem. Like how do you manufacture ships, ammunition fast enough to fight in a war quickly? So because of these three problems, national security, resiliency, and social and political problem, there is a bipartisan consensus in the US that whatever has happened over the last 30 years needs to change. And that's exactly what we are seeing. Does it come in terms of tariff? Does it come in the form of subsidy? We don't know. But the final destination is very clear, to bring back manufacturing to the US.
And Ashish, tell us a little bit about the impact that labour supply piece has on things like immigration, which we know is an important topic in the US. So with the shift in manufacturing and immigration, what are your thoughts on that?
Immigration is very important. If you think about US population growth, roughly half of the population growth comes from natural change. Other half comes from immigration. So if you slow down immigration, you have less population growth, and that creates problem both in terms of demand and labor supply. And right now we are not seeing that because economy is slowing at the same time when immigration is slowing down. But when the economy recovers, we can see labor market tightness. So that is a problem. But that problem will be solved through more automation, technology, and hopefully AI helps there. So we are going to see accelerated investment in automation whenever the economy recovers and the current period of volatility subsides.
There's a lot for businesses to think about at the moment. We're going to come to that aspect a little bit later on in the conversation. But Marcel, just shifting over to you, what's the flip side of this coin then that Ashish is talking about for Europe? What opportunities does it create, and similarly, what sort of risks?
Yeah, so I mean, the flip side obviously is, the tariffs that Trump has put through, whether they end up being, 10% that we've seen on the UK, or probably my guess would be something maybe a little bit more punitive, will obviously, all else equal, have a hit on European competitiveness and European, just GDP growth for the next few years. But I think as I touched on, those will be hopefully short-term impacts. Prices will reset, and Europe will adjust. But actually, what we've seen through this that can have a 5-10 year view still is actually Europe becoming, the United States of Europe rather than the European Union. I mean, one of the stats that I think is amazing is US GDP per capita is twice the level of Europe. And you go back 20, 30 years ago and it was much more similar. And, the last time I checked, the US doesn't have some space alien technology. It's not that the population is, twice the IQ of the population in Europe. It's basically just the environment that the US has created, that fosters growth. That's one single market, all of these kind of things, limited red tape. And if Europe can, even move towards that direction, and I think now there's finally a political will to do so, that could be a big game changer.
So we'll be moving from a US exceptionalism to some European exceptionalism, perhaps. I mean, Charlie, the investors that you're talking to, is this an exciting prospect for them? Are they sort of keen and raring to go for more attention to Europe?
I think it's a really interesting time because we've seen, again, with the institutional investors that we're talking to, that there's been this, over many decades almost, globalization, the focus to invest on a global basis. And that has meant that I think certainly for markets like Europe, that has been less of a focus. But I'm excited to see how that shifts now with the opportunities that we see coming in Europe.
And what about policy then in Europe, Marcel? So you've talked about the bright sunny uplands that maybe we can expect in the region. What needs to happen on a policy level, and what do you think is realistic to expect?
Yeah, so the great thing is, we have a roadmap of sorts in terms of the Draghi report, which, was released a few months ago and now is really kind of being embraced in terms of, allowing things like national champions, across Europe, for example, allowing banks to kind of, merge cross-border. It's a bit, nobody wants their bank to be acquired, no country, but actually for Europe as a whole, consolidation in this industry would be very powerful. If you think, if we could have a European equivalent of JP Morgan or, Bank of America rather than 20 different kind of national champions, that would be very powerful. And then another thing is mobilizing the savings rate. So, Europeans save, very large amounts, but more importantly, kind of where they put those savings is very different to Americans. It tends to be much more, fixed deposits, bank accounts, under the mattress, that kind of thing that we, economists refer to as non-productive savings, because obviously that doesn't get recycled back into the economy. So, if we saw something to misquote the prior government here in the UK, a great European ISA, for example, to kind of incentivize investment in Europe and mobilize that savings rate, that could also be very powerful.
So Ashish, what does that mean? What does all of this mean for growth and inflation in the US?
Yeah, so one is very near term and then one is on medium term. On very near term, because of these tariffs and all, it creates uncertainty. And then the companies want to know what are the rules of the game. And since right now rules are still evolving, so they slow down a little bit. So we should expect some kind of negative impact of the current period of volatility on growth. And we should expect at least one-time price increase because companies cannot take hit on margin. Now, in terms of medium term, we'll have to see whether this one-time price increase will result in a recurring inflation or will it be just one time? We don't know. And second, in terms of growth, what is more important than growth is the nature of the growth. We firmly believe that the nature of the growth in the US will change and it will move more towards fixed asset investment. So over last 30 years, as I was saying earlier, the US, the capital light part of the economy has grown a lot. Over next 10, 20 years, the fixed asset investment in the US will grow at higher rate than GDP. And that will be what will be driving the economy of the US. That will be one of the most important engines which the investors have not focused for the last 15 years.
What is it that needs to happen in the sort of short term in order to ensure that trajectory takes place? For example, what are you expecting the Fed to be doing over the next few months? What can they do?
Actually, from the Fed point of view, they can't do much. Most of the things which need to happen is from the government. And there are two key things there. Tariff and then tax and regulation. So tariff needs to become clearer, how much tariff on which country. And then second, that the tax bill is going through the House and Senate. And there we need to know what are the incentives for the companies to invest, like bonus depreciation and so on, and deregulation. And once you put all these things together, that will kickstart fixed asset investment growth in the US. You need a certain knowledge of tariff, you need tax which benefits you, and then you need deregulation. And that can be very powerful on a medium-term view.
And what can the ECB do? Can they cut more than the Fed?
Yeah, I would think the ECB probably has more headroom to cut than the Fed, given, there's not as big of a tariff shock, potentially pushing up pricing. There's more slack in the labor market, given obviously Europe can tackle quite a wide pool of labor. So I would probably expect the ECB to cut ahead of the Fed, yeah.
Should we talk about investment implications?
Sure.
What sectors do you see in Europe as having the potential to sort of outperform in this market?
Yeah, so I'll take a bit of the long way home to answer that question, if that's okay. If you look at Europe as an index, the MSCI Europe, around a third of it is domestic and 2/3 is non-domestic, which is a stat that often kind of people, I think, misunderstand. People would think that, Europe is more important to European companies than it actually is. And that's the legacy of what Ashish was mentioning, that European companies, just like American companies, have been selling abroad and have been moving to capital light and that kind of world. So, you think of, an LVMH, selling a lot to China, and SAP selling a lot to US, etc. And over the last 20 years, the successful playbook for investing in Europe has been, to focus more on those 2/3 that are selling outside Europe than to focus on the 1/3 that's selling to Europe, because obviously European growth has lagged global growth. And that's meant, actually, if you followed that playbook, the index as a whole has actually kept up pace, the MSCI Europe with the MSCI World over the last 20, 30 years, because of the fact that those world-beating, 2/3 can sell outside Europe. And now, potentially, we might get a world where that gets flipped on its head, where the 2/3 kind of does okay in line with the rest of the world, but where the 1/3 sees growth accelerating, if Europe can actually pull its act together. And therefore, for us, we see some of the most interesting opportunities in domestic European players, airlines, banks, kind of these type of players that, have a market that's somewhat isolated from all of the chaos in the world and actually could benefit from, the European GDP revival.
What about those European companies that are exposed to the US or that have a lot of interest and investment the other side of the Atlantic? What are you expecting to see there, and how does it vary between sectors?
Yeah, so I think it differs massively based on, whether it's a capital light or capital intensive industry. So for example, software, European software, is pretty much immune to tariffs and pretty much immune to, reshoring or any of that kind of push, given, you fire up your computer and you download the software and there's little that kind of Trump or anybody can do about that. But other players, such as European cap goods names, even areas like autos, aerospace, I think probably are going to be expected to invest more in Europe and into the US, should I say, if they want to sell into that market going forward. So we'll see probably a reorganization of global supply chains, not just for American companies, but even for European companies that want to sell into the US.
Ashish, we're going to come to your investment ideas in a minute, but I just want to briefly shift our focus to a sector that's recently found itself in the spotlight, specifically Donald Trump's spotlight, and that's pharmaceuticals. Producer Paddy spoke earlier to our pharma analyst Emma Newey-Clark to hear about how she's assessing some of the announcements that have been coming out of DC recently.
Emma, you cover pharmaceutical companies at Fidelity. It's obviously been a busy few weeks.
Yes, it has. Yep.
President Trump's executive order on drug pricing came out just some time ago. What does it tell us?
Currently, very little. We kind of know what he wants to do, and he wants to lower US drug prices to much more similar to ex-US drug prices, which can kind of be 10 times cheaper than they are in the US. But at the moment, all we know that he's going to do is he's going to present to in 30 days, pharmaceutical companies a price that they want to change to, but without really any detail on how legally that's going to be enforced or upon the companies. So at the moment, it feels like he wants to negotiate, but we don't know any detail beyond that.
Okay, so how do you fill in those gaps?
So I try and take a high level view on what's he trying to achieve. So on drug pricing, obviously, I know he's trying to cut the price. And I try and think of legal mechanisms that he might do that. There is one way that the Biden era actually passed where they now negotiate a list of drugs every year. So that list seems like a very easy way that you can get that price down. Beyond that list, it's much harder to see how they're going to do it. There might be a demonstration project. There might be something passing through Congress. I just try and take a step back and look at a company's exposure to the US, how much they sell to Medicare, which is the kind of government-funded part of the US healthcare system. And also I try and look at, how much US sales they have. So a company that sells less in the US will have less exposure. And if there are any kind of particular drugs that he seems to be talking about, like he spent a lot of the press conference talking about the fat shot from Novo Nordisk. So, that seems to be a focus. So that's the kind of thing I'm trying to look at.
Okay. And that leads you to some sort of scenario analysis with the companies, does it?
Yeah. So overall, given that he's trying to do quite a few things on pharmaceuticals, not just drug pricing, he's also trying to bring more of the manufacturing back to the US. I try to do scenario analysis for each company and look at, where do I think they might be exposed on drug pricing, where their US manufacturing base is versus their ex-US manufacturing, and their current tax basis. Like if they've got a 15% tax base, but a lot of US sales, the chances are they are transferring profits out of the US. So I try and put all three of those together to kind of come up with a potential EPS scenario. And, it can be, given the lack of details, it's a very wide scenario analysis at the moment, from a very small EPS headwind to kind of almost an existential one.
So earnings per share,
yes,
just for
earnings
for
per
the
share,
uninitiated.
yes, yeah.
Where do you think all of these threats leave the pricing of drug companies now?
Taking just a high level view, he's obviously going to do something on drug prices, which affects the revenue. So I need to think about the impact on revenues, and that it's in some shape or form likely to be a little bit lower than it was. Then on the cost base, if your US is an expensive place to manufacture, particularly if you're suddenly having two sites where you used to have more, I've got to think that the costs might be a bit higher than they were. And then the tax rate, if you're moving more manufacturing to the US and more IP to the US, your tax base is also going to go a bit higher. So I've got very wide scenarios, but I think the base case has to be slightly lower revenues, slightly lower or higher costs, and slightly higher tax rate.
Right. And the scenario that's currently priced into market, you'd say is that severe, or is it moderate? Or?
I would say it's not the severe case currently priced in. I would say you've got a bit priced in, but we're not at, if you look at the share prices versus a year ago, on average for the sector, we're a little bit down. We're not existentially down. So I would say a little bit's priced in, but I wouldn't say the kind of worst case scenario. We're anywhere near the worst case scenario.
Emma, thanks very much.
Great.
So Patrick Graham talking to Emma Newey-Clark there. Now, Ashish, Emma was talking about current pricing, how markets are reacting to some of those sector-specific announcements. How is policy playing into your investment strategy at the moment?
Actually, we had been anticipating these kind of issues for a long time. So in our investment strategy, investment process, actually not much has changed. We are exactly doing the same thing, looking at the company, looking at the long-term prospect, looking at the valuation, and trying to think through, if the US has to bring more manufacturing back to the US, are there beneficiaries which are not priced for that? And we have been doing that for a long time, and we continue to find opportunities. So we are doing work at our own pace. These things are not really unexpected from our point of view. The volatility has been very high, which has been throwing us opportunities. Like there were some companies on our radar, which we were not able to buy because of valuation. And in April, we got opportunities. So we jumped on those opportunities. But yes, no change in process strategy. And we continue to do this bottom-up work of looking at the company, what is priced in, what is not priced in, and finding opportunities to buy.
The information that you get from the likes of Emma and the other analysts that we have, how do you absorb information from them at these periods, in these periods of volatility? How does that information kind of help you with your investments?
Whenever you have these kind of policy changes, it impacts earning power of different companies differently. And we need deep, detailed analysis, like how each company is impacted. So the work which Emma does tells us, okay, this pharma company, it matters like this way. For this pharma company, this is what the earning impact. And we can incorporate that in our investment process, investment philosophy, see where there are more incremental, better opportunities. So this work is very, very useful to put the numbers around the policy changes.
And I know, Ashish, that you were talking to some of our analysts in China not that long ago when some of these tariff announcements were starting to filter through. Can you just tell us a little bit more about how that helped you and your sort of outlook for the coming months?
Yeah, it's very useful. I remember like when Liberation Day happened, our analyst in China, he went around China and met companies which were on the front line of this tariff war. And those companies had very interesting insight. Like, this is how we are going to deal with this tariff in the short term, in the very near term, in a week, for a month, and long term. And it made us clear that if the tariffs which were put on Liberation Day, if they continue, it will cause a lot of disturbance in the supply chain. It can result in shortage, like the way we saw in COVID. And if you take that analysis one step further, you can see if the situation is so dire, maybe it will not continue. Maybe there could be rollback. Maybe there will be changes. So we start thinking through second, third order impact. And that only becomes clear when you talk to companies, when you talk to customer supplier, the big picture emerges and that things are not the final. It will evolve, it will change.
And thinking about your investment process and the information that you're getting from the analysts in Europe, how does that impact what you're doing day to day?
If you think in Europe, for example, we have 30 different analysts, that's each with their own unique subsectors from a kind of sector point of view, but also from a stock point of view, each of them covering 25, 30 stocks. That's a level of detail that as a fund manager, we'll just never be able to keep up with, and in the normal state of the world, there's usually one news item that happens impacting one sector at a time. But in times like current volatility, where it seems like every sector is being impacted to some degree by current news flow, it's extremely helpful just to have the bandwidth and then, as Ashish touched on, the capabilities and insight that they have to be able to uncover what's actually going on.
There are plenty of companies out there that are having to reassess and move with the shifting sands. You mentioned capital-intensive companies earlier, Ashish, and I wonder, to the extent that the outlook that they have at the moment, given the uncertainty, if these companies want to build factories here, in the US or abroad, or they want to order big equipment that they need to get, all of those questions surrounding how much they might be having to pay for all of the above. Currently, there are huge question marks. So how do you and the conversations you're having with companies, how is that sort of filtering into your outlook for those types of businesses?
Yeah, so based on the current rules, it is very, very hard, right? To have a new project, have a new factory in the US, you need to know how much will the equipment cost, how much will the labor cost, how much building up of this factory will cost, what price you can sell, what will be the competitive dynamics, and so on. Only then you can go ahead and make $2 billion, $3 billion investment. And because the rules are still evolving, you don't know what will be your return on capital. And in some cases, in a very weird way, your return on capital has gone down because you're importing equipment from Japan and Europe, and that costs you more, right? So the companies are not able to decide right now. But it is very, very clear, no matter which company we talk to, that the current supply chain is not fit for purpose. It is going to be reconfigured, and it will mean local for local. So the companies, by this way or that way, they will come up with a solution to have better local for local capability so that they don't get caught up in these kind of disturbances anytime in the future. It will take time. We need to know the rules of the game, but that will happen.
And is that something you're also seeing in Europe, Marcel?
I would say Europe is taking a bit more of a wait and see approach. It's not as kind of important for them to be first mover advantage, in this. I mean, a number of European companies obviously have big-ish as a proportion, US manufacturing facilities already. But I think I would say the typical company that we're seeing in Europe is not quite sure what to make of the U.S. administration and the medium term, is probably holding back a little bit. But if what Ashish says is correct, which I don't have a reason to doubt, I would be surprised if European companies aren't fast followers in terms of moving to the US too.
To sum up, the shift in supply chains and the impact that will have for the global economy will be fascinating, and also the sort of the nature of growth itself will potentially change both in the US and Europe. So really interesting insights. Perhaps just coming back to the central question, should they stick with the US?
Both of you can have a 30-second pitch for your respective regions. So Ashish, yes, you first.
We believe that US still remains one of the best places in the world to invest. And the prime reason is the US, among all the developed world, has the best demographic profile. Be it natural change of population growth or be it through immigration, for the next 20, 30 years, it will have the best population growth. And if you know anything, among developed world, if a country has a declining population, it is very, very hard for that equity market to outperform. So the best demographic profile, continue to be the most innovative economy, and has one of the most diverse range of well-managed companies. But more important, investors need to look beyond the companies which they have focused over the last 10, 15 years. These are these hyper-growth, hyper-valued tech companies. And these are the companies which dominate the index. So we will highly encourage investors to go beyond the index, focus on the middle America, where there are better companies and where they will have better growth prospect over the next decade.
I think you hit a minute there, Ashish, but it was very compelling. So I'm going to let you get away with it. The demographics challenge then, Marcel. So for you on Europe, off you go.
Yeah, so, as I touched on, Europe has been able to keep up pace with the world over the last 20, 30 years. And it's really been a case of doing so with one hand tied behind their backs. They've been able to do that, through kind of being world beating on the global stage, but having a really tough macro environment within Europe. We've had Eurozone crisis, migrant crisis, Brexit. There was even a Grexit at one point. If that just stabilizes somewhat, valuations are still at very attractive levels, Europe versus the US, Europe versus its own history. And we think, that with three hands all in front of your back rather than one hand behind the back, Europe could actually be quite an attractive industry over the next 5-10 years.
Fantastic. I'm being told in my ear that was 45 seconds, so very, very, very good. Right. Well, Charlie, I hope that's gone some way to helping you answer that question, which I know is, as you said, is at the front of everyone's minds at the moment. We're almost out of time, but before we wrap up, we will play the traditional Fidelity answers game, which is hot cakes and hot potatoes. What would you buy like a hot cake? What do you drop like a hot potato? And Ashish, I'll come to you first for that. What's your hot cake?
We'll say middle America, which is value US.
Excellent. And your hot potato?
Hyper growth, hyper expensive tech companies in the
Drop
US.
all the tech companies, okay. And Marcel, your hot cake?
Yeah, I would say my hot cake is European banks, really at the kind of epicenter of all of this coming together.
Mm-hmm.
Still very cheap, paying back lots of capital, lots to like.
Lovely. And your hot potato?
Hot potato, I would say non-German defense companies. They've done very well. They've kind of doubled or tripled. But a lot of their exposure isn't really in the areas where you want. A lot of them have exposure to the US or UK, which will be much slower defense growth markets than, countries more east of that in Europe.
Excellent stuff. Thank you very much. And because we like to provide as much information as possible to our listeners, we're also very keen to hear about what you've been listening to, watching, reading, seeing in the last few weeks, what's been grabbing your attention. And Charlie, I'm going to start with you. What's your recommendation for this month to listeners?
I listen to a lot of music, and when I'm walking to work and at every possible time, I have quite an eclectic taste in music, and I'm reliving my youth with some 80s and 90s music Excellent. At the moment. But I have been to listened to Lady Blackbird in Hackney recently, and that was amazing.
In East London.
In East London, yeah.
Very nice, very nice. I like the nostalgia. The trip down memory lane.
Memory lane.
Worth doing. Marcel, to you, what's catching your attention?
Yeah, so I read a book called Richer, Wiser, Happier recently by Will Green, and just a fantastic book as the name suggests. It interviews kind of 10 or so of some of the best investors in the world over the last 20, 30 years. And it talks a lot about investing, but as the title suggests, it also talks about how you can be wiser and happier in your day-to-day life, which, I guess we could all do a little bit with.
Nice. You're a very fully rounded person.
Yeah.
Ashish.
Yes, so we are bottom-up investors, and anything which takes me to a deep dive of any company, I just love it. So I would highly like to recommend Acquired podcast.
The podcast.
Every company for 3-4 hours, and it's just amazing.
Incredible amount of detail they go into. I recommend that one as well. Well, look, thank you very much to all of you for all of those tips. And that really is all we have time for. So I want to thank my fellow co-conspirator, Charlie Wood, today for joining me in the hot seat, and to our portfolio managers, Ashish Bhardwaj and to Marcel Stotzel. And also thank you to Emma Newey-Clark, our analyst on the show today. And thank you for listening. You can read more on the topics that you have heard about today on your local Fidelity website or at fidelityinternational.com. I'd like to thank the production crew today. So our producers were Holly Eastman and Patrick Graham, with additional production support from Alex Wilcox. And if you have enjoyed what you've heard here today, please do like and subscribe and share very widely. But for now, from all of us at Fidelity, goodbye.